So good morning, everyone, and welcome to this post-federal budget review by one of our valued chamber members, MNP. My name is Tertius Janis, and I'm chair of the board for the Grand Prairie District Chamber of Commerce. I would like to start off by acknowledging that we are meeting on Treaty 8 territory, and we honor and also acknowledge all of the First Nations, Métis and Inuit peoples who have lived, traveled, and gathered on these lands for many years. I'm very proud to say that our chamber is the third largest in Alberta, with nearly 1,200 member businesses, covering a variety of sectors and employing some 20,000 people. Today, with the help of Tracy and Heather from MNP, we will try to determine how yesterday's federal budget announcement will impact you and your business. They will discuss specific details and answer questions to help you prepare for your future. This falls in line with our mission to facilitate and inspire world-class success of our businesses and our community members. Please note this session is being recorded to be shared with those unable to participate. And during the course of this presentation, you can also use the chat box to ask questions or use the raise hand function if you are more comfortable with that. Heather Hilhorst is a partner in MNP's Tax Services Group. Serving the Grand Prairie and Peace region, Heather works with clients in various industries, including construction, oil and gas, and logging, delivering effective taxation, succession planning, and tax planning services tailored to their specific needs. She provides strong advice and guidance that helps clients with Canadian corporate tax planning, succession planning, and purchasing or selling a business. She excels at explaining difficult to understand concepts so that they make sense and presents innovative ideas and solutions to help clients achieve their goals. Tracy Lishman is a partner with MNP's Taxation Services team in Grand Prairie, specializing in Canadian taxation services. Tracy works with family-owned and managed businesses in a variety of industries, including agriculture, oilfield services, professional businesses, forestry services, and retail. A skilled listener, Tracy develops an in-depth understanding of her clients' goals and challenges that allows her to create customized solutions that help them succeed. Tracy has more than 18 years of experience working with entrepreneurs in the areas of personal and corporate tax planning, corporate reorganization, and estate and succession planning. Please welcome Heather Hilhorst and Tracy Leishman.
Thank you very much. All right. So thank you everybody for joining us here today. Our goal is to walk you through some of the relevant tax changes or proposals from yesterday's federal budget. So yesterday afternoon, the Honorable Minister of Finance and Deputy Prime Minister Chrystia Freeland tabled the 2022 federal budget. There was a really large focus on, four key areas, and that being affordable housing, economic growth, clean energy, and public healthcare spending. I don't think that was a surprise to any of us. Sorry, Tracy, I went straight away from slides. But today we're here to focus more on the tax stuff. So I'm just going to jump ahead to where we got here. So today we're going to focus on corporate tax first, relevant personal tax changes. There were a few key highlights with indirect tax, or that's your GST, HST, touched briefly on international tax, and then we'll also talk about prior proposals that are still outstanding and left for us to address here. So along with these changes, there was a mention of other consultation programs and processes for other key areas. We'll touch on those briefly here as well. So going into the corporate tax measures, we will talk about these kind of key tiles here. Small business deduction, the taxation of a new definition of substantive CCPC, the discussion of an introduction of an employee share ownership trust, a new tax to the banks, investment tax credits for carbon capture, utilization, and storage. Say that 5 times real fast. And then support for clean air. There was also, speaking of consultations, future consultations regarding future corporate taxes and some changes to how residential real estate held in a company will be recorded on the tax return. So I think starting off with probably one of the most exciting changes. It's a very welcome change for us. We as a firm have been advocating for changes to the small business deduction for many years, and we hope to see further progress on this. But the budget 2022 expanded the eligibility for small business deductions. So previously, the small business deduction, which is the income inside your corporation that's taxed at what we call the low rate. So in Alberta, that's 11% on your first $500,000 worth of income. Anything over your first $500,000 is taxed at 23%, or the general rate. So previously, the small business deduction began to be phased out at 10 million and was fully phased out, meaning you had no small business deduction or no income that could be taxed at that 11% once you hit $15 million worth of taxable capital. This really limited access to the small business deduction for really capital intensive businesses such as farms. So budget 2022 proposes to expand the phase out, meaning that it will continue to phase out at that $10 million mark, but be fully phased out at 50 million. So this will give significantly more businesses access to these lower rates to grow their business. And meaning that somebody with 30 million, of taxable capital under the old rules, you'll see in our table, had zero capital or small business deduction, today they would have, or after the budget is enacted, they'd have 250,000. Do note that the adjusted aggregate investment income, or what we all know as the passive income or investment income grind to the small business deduction, remains unchanged. So if we have investment income inside of the business or the corporate group, the associated group, of 50,000 to 150,000, we will also still grind our small business deduction. So that remains unchanged. So here's a pretty table that shows the changes with our small business deduction and the expanded phase out. So as mentioned previously, we were fully phased out at 15 million, and now we're fully phased out at 50 million. So this has been a hot topic here for the past year. This is our beloved, what we call Bill C-208. And maybe not everybody is, this is as near and dear to everybody's heart as it is to mine and Tracy's. But this summer, Bill C-208 was released as a private member's bill, or it passed through the House. And what this does, just as a little bit of a background, it allows access to capital gains exemption on the intergenerational transfer of a business. So before Bill C-208, selling your business to your kids was far less tax effective than selling to an arm's length party. And this is something, again, we've been advocating for years on trying to get a fix for. So fast forward to this summer, this past summer, I guess, Bill C-208 passed through the House and the Senate and became legislation. And there are, there are some flaws, I'll call it, in the bill. It was a private member's bill. So the government immediately said that there will be changes made to the legislation. So originally they had told us those changes would come, on or after the beginning of November. No news there. We thought maybe this budget would announce further changes to Bill C-208, and there was no news either, other than saying that they're going to launch a consultation process on Bill C-208 so that they can ensure the integrity of the tax system while continuing to facilitate these intergenerational business rollovers. So they are welcoming comments from stakeholders up until June 17th, 2022. And we will expect a very exciting fall economic update as a result of this. Also important to note that I guess Bill C-208 also relied on that taxable capital threshold, the cap out at 15 million to access your capital gains exemption. It doesn't appear that the changes announced in yesterday's budget to the taxable capital for small business deduction are also being mirrored for the legislation for the intergenerational transfer. So that's something as well that we will stay tuned to see if those marry up at all. So another tax change that will impact some people, I guess, just as a bit of background here as well. Inside a private corporation, investment income is taxed essentially similar to the combined rate of an individual and a corporation. So tax on investment income inside of a business is taxed at about 47%. So when we're looking at that, we can compare that to the tax of a public company, the tax rate of a public company or a foreign-owned company, which is 23%. So there were some people that were structuring their affairs in a way to access or align their tax rates with, the same tax rates that a public company or foreign-owned business would get on their investment income. So Budget 2022 proposes to treat these entities or these structures the same as a CCPC or a Canadian-controlled private corporation, and continue to tax that income at the higher 46.67%. So the budget also very briefly addressed employee share ownership trusts. It's intended to help businesses transition to an employee held group. It would be a new type of trust under the Income Tax Act, but there was no real further information other than the intention to develop this new sort of trust in the budget. So stay tuned, I guess, on that as well. I think this is leading into the whole idea that, we have a lot of people looking to pass their business on, and we have baby boomers ready to retire. So new measures in the areas of succession. So the new bank tax, this was, it's called the Canada Recovery Dividend. And what it is a one-time 15% tax on banks and life insurers on any taxable income over $1 billion. So this would be their taxable income for 2021. So effectively, we're taxing last year's income at an additional 15%, and the amount would be paid over a 5-year period. There was also the proposal to increase the tax rate on banks and life insurers by an additional 1.5% on any of their income over $100 million as well. So we'll see how the stock market reacts to this as well. So clean energy, again, a huge hot topic in the budget. This is, the investment tax credit or ITC for here we go again, carbon capture, utilization, and storage. So it's a refundable ITC for eligible expenses incurred on or after January 1st, 2022. And the credits between 2022 and 2030 are going to range from 37.5% to 60%, and then slowly phase out after 2030. So there is, you have to have eligible equipment that is part of a project to capture CO2, and it has to be used for an eligible use. So hopefully, again, more information will be released on that soon. And I think the other interesting thing here is the requirement to provide a climate risk disclosure for this. And this disclosure is meant to highlight how the corporate governance strategies and policies are going to help manage climate-related risks. So again, no real information on what that'll look like or how that needs to be produced or who has to produce that, but that will be one of the disclosure requirements with respect to this new CCUS tax credit. So more clean energy, this is the expansion of preferential CCA classes or capital cost allowance classes for clean energy heat pumps. I'm not a pro at clean energy heat pumps, but I understand that it is intended to transfer heat from an outside area and use that to heat air or space. We had a joke in our team meeting this morning of what happens when it's -40 and there is no heat from the outside area, but we won't worry about that today. And so again, another consultation or review on the tax system. So the goal here is to ensure that it's providing adequate support for growing businesses and address any barriers that would be preventing them from growing. One specific mention in this area was credit card transaction fees. No comment on how it will be dealt with, but that was definitely one cost of business that was addressed in the budget with respect to the growth of small businesses. Okay, and so flow through shares. So flow through shares basically allow the entity to pass on their expenses to the investors and offset them with their income. So historically, a common one that we have seen is flow through with respect to oil and gas and coal exploration. The budget, I guess, in the nature of clean energy, announced that they are going to eliminate the ability to renounce expenses on flow through shares for oil, gas, and coal for any expenses after March 31st, 2023, so next March. And on the contrary, they did introduce new flow through shares or new eligibility, I guess, for critical mineral exploration. So that would be minerals used in the production of batteries and permanent magnets, so clean energy. And this would be for any expenses, eligible expenses after budget days, so entered into, incurred after yesterday. So there is another review here with respect to companies holding residential real estate. So I think it's more of a study of trying to figure out how much real estate or residential real estate is held by corporate players and the impact on the market. So there's a proposal to introduce a new class of assets on the tax returns so that the government, I guess, could substantiate how many players there are in the residential real estate rental game. So further details will be released on this review later this year. Oh. And that was a flurry of corporate tax changes.
Right. Well, thank you, Heather, for that. And I agree with you on the climate change. I do need to learn what some things are here and how that would apply to our clients here. But I will dive into some personal tax measures now. And I think we found with the budget, there was a lot of stuff in there, but we've kind of focused our discussion here on the what they've done for housing and to make housing more affordable, and just a couple other comments on a few things there. So they did bring in quite a few new tax measures with a multi-generational home renovation tax credit. The home accessibility tax credit has been changed. The first-time home buyers tax credit has been increased. And there's a new tax-free first home savings account. The first home is going to be tricky on all these. And then to counter that, though, they've also brought in a different taxation on residential flipping. So that will cover a lot of the home ownership. And then they also brought in a deduction for people who are mobile with tradespersons who are moving around to do their work. And we'll talk about my favorite alternative minimum tax, which is not my favorite tax ever. So with it, so the multi-generational home renovation credit is proposed by the budget to allow a credit against eligible expenses for qualifying renovations. So again, a lot of stuff that we don't know for sure on this. It will apply for purchases made after January 1st, 2023, but it is looking at a renovation that will allow for a secondary dwelling to allow for an eligible person, which is a senior or person with a disability, to live with a qualifying relative. So with this, it'll be eligible expenses of the labor, professional services, building materials to complete the renovation. And the credit will be equal to 15% of the lesser of the expenses actually paid, up to a maximum of $50,000. So the maximum credit would be $7,500. So again, hopefully we'll have some more information out on this later this year. And then for 2023, if you are looking at doing a renovation, make sure you're keeping all of your receipts and documentation, as you may have now a deduction to claim for that. The home accessibility tax credit. So this credit's been around for a few years. It was 15% of up to $10,000 of eligible expenditures. And these eligible expenditures related to modifications to homes to make them more accessible. So this applied to people that were eligible to claim the disability tax credit, or people that were 65 years of age or older at the end of the taxation year. So if you're having to do any modifications to your home to allow it to be more accessible, to allow you to move through it better, and basically to help you stay in your home, you know, again, keep your receipts for that, and because they have up the credit from, instead of a $10,000 limit to a $20,000 limit for this year and future years. The first-time home buyers tax credit. So this tax credit, again, has also been around, and it is to help people buy their first home. The credit used to be $750 and has now been increased to double the credit to cover a maximum of $10,000, and the credit is $1,500 for that. So it does help people buying their first home, and this applies to homes purchased January 1st, 2022 and after. So if you've purchased your first home already this year, you now have a bigger credit to claim. Again, with, I guess, the past 3 credits and more credits I will talk about, make sure you're talking about these with the person preparing your personal taxes. As a personal tax preparer, sometimes we forget to ask all of these details, but you'll make sure you are telling them that you have bought a new home this year or renovated your home. This one, new one, is a very interesting one. It's a tax-free first home savings account. So this will be a brand new registered account that people can set up starting in 2023. And this is to help, again, purchase a new home. So you would be wanting to save up to purchase your new home. You'll want to set up this new account. And with this account, you will be able to contribute monies to the account on an annual basis, and you'll actually get a deduction for contributions made into this account each year. The amount that you can contribute each year is limited to $8,000 per year, with an a maximum lifetime contribution of $40,000. So once you put this money into this account, it can grow tax-free. And what is very unique about this one is if you make a qualifying withdrawal from this account to purchase your first home, that withdrawal is not taxable. So generally, before we had a first-time homeowners home buyers plan through the RSP system, but you had to either repay it or pay taxes on your withdrawals over time. This one, the $40,000, if you've saved it up, can be taken out of the account tax-free as long as it's used to purchase your first home. So I would say if you know anyone that is looking to save for a first home, this is something I would certainly look into more. And again, with it, if you're saying, well, I don't have $8,000 a year to transfer to this new account, they did allow, if you have money in an RSP already, you can move funds from an RSP to this FHSA account and do it on a tax-free basis to allow you to put the $8,000 a year into this account from an existing registered account. One thing to watch though is if you do move it out of your RSP, you can't move it back to reclaim your RSP room. So I'd say you really have to kind of take some time and think about what you're doing. But again, because you can actually take funds out of here to buy a home without paying tax on them, that's going to help people with their savings and a considerable tax savings there. So again, though, we don't have all the details on this, so I'm hoping what I'm saying and what the budget is what the reality will be when it comes out. So again, please stay tuned on that if you're saving for your first home. So now to counter all of that great stuff, they've also brought in, and if you've been kind of watching over the last few years, if you have sold a principal residence, your accountants asked you for details on that because we are now, they're now tracking and we're reporting the sales of principal residences, and they have kind of been monitoring this. So what they've brought in now is to say, if you've bought a home and it's to be your residence and you're living in it, but if you live in it for less than 12 months and you sell it for a gain, instead of that gain being tax-free as your principal residence, it will now be taxed, and it'll be taxed as business income. So instead of even being taxed as a capital gain where 50% of it is taxable, they've gone on to say no, 100% of the gain on a home sold, if you were in it for less than 12 months, will be fully taxable as business income. They have brought in quite a few exemptions to this though, because there is things in life that just happen where you have to sell your home. So if those things happen, they have allowed those ones to be exempt from this new tax. So just to watch that, if you are buying and selling and moving homes quite frequently, the taxation of that is going to change drastically for you. So that kind of covers our discussion of homes. So for sure, if you're looking at buying a new home or your first home, certainly you'll want to look into all of those great things. If you're a frequent seller of your home, though, please beware. The next personal tax measure that they brought in was to help, and it is really to help with the labor shortage that there is in the country now. And I think we're seeing in town here that skilled labor is very difficult to find. I know I have trouble finding skilled labor. If there's skilled labor out there, I'd love to meet you. But it is to allow people that are having to go, and especially more tradespersons that are working on different job sites and are having to travel to the job sites, they're allowing them to claim up to $4,000 in eligible expenditures for a temporary relocation each year. So if you're having to pay out of pocket for expenses to go to a different job site for a short period of time, this applies now to 2022 and later years. So again, with everything, please keep your receipts, then you can claim them. This one has always been my favorite tax. It's called the alternative minimum tax. And it's been in place since 1986, and it hasn't been really looked at since then. I've always hoped that they would actually eliminate it because it just becomes a calculation nightmare. And I'm always quite happy that I have a computer that does the calculation for me. But they're actually looking, and they're saying that there's a lot of taxpayers out there that are paying, that have income over $400,000, but are paying a tax rate of less than 15%. And they're trying to target these taxpayers that have quite high income, but have quite a low tax rate because they've been using deductions. And I guess one of the common ones we see here is people that are finally at a stage where they've built up their business or built up a farm and are finally selling it and are able to use their lifetime capital gains exemption because they've either sold qualifying small business corporation shares or they've sold qualifying farm property. And in those cases, you can, you have to report your gain as income, but you get a deduction of your lifetime capital gains exemption. So for those people, quite often we see this minimum tax get triggered, and it can be quite a high tax, but the idea behind it was to tax you in the year of a sale like that. But then this tax goes into a pool that gets refunded over a few years. So I probably said way too much on that because it's one that I run into that I always feel is a tax that you pay when you think that you're not going to pay a tax. So they are looking at it, and I hope they don't make it more complicated, but stay tuned. And that was kind of, I would say there was quite a few more little personal tax changes that have happened, and a few things again for people with disabilities, there's some different claims with that. So again, when you are talking to your personal tax preparer, if you have disabilities or have children with disabilities, please make sure you bring up kind of any expenditures that you have, because there might be a claim for them, even though there hasn't been in the past. They've certainly changed a lot of those claims. So just, you know, make sure you're having the discussion with your tax preparer. I'm going to switch it over to Heather again for good old indirect tax, another favorite tax wars.
Thanks, Tracy. So just, I guess, a few changes with respect to the indirect tax or GST, HST regime. Pretty ho-hum in the grand scheme of things after last year's big announcements of luxury tax. So these are much, I guess, less exciting changes. But first up, the GST, HST healthcare rebate. This was expanded to give access to this rebate, the 83% healthcare rebate, to any facilities that are overseen by a nurse practitioner. Previously, it was restricted to facilities overseen by a nurse practitioner. They would have to be in remote areas for it to qualify. If it was an NP or nurse practitioner overseeing it, and in all other areas, it needed to be a physician. So an expansion of this rebate we see there. Following up on the hot real estate market and access to affordable housing, there was an introduction of a new GST, I guess, or a taxable supply with respect to what they refer to as assignment sales. This deals with speculative trading in the housing market. So somebody buying, a condo or a house from the builder prior to it being completed, claiming they were going to live in it and then selling it on speculation after the fact. Currently, on most of these, there was no GST that would apply because they stated their intention was to live in the place, and so no GST. Now GST will apply on the amount paid for that home. So they're giving a month, I guess. It applies to any purchases on or after 1 month from budget day, so May 7th. And then an update to our sin taxes. A new excise duty for vaping liquids come into effect after October 1st. The relief, so no longer charging excise duty on non-alcoholic beer or beer with less than 0.5% alcohol in it. This marries it up to the same tax or excise tax as other non-alcoholic beverages and also in other areas. And then also the repeal of the 100% excise duty exemption on Canadian wine. So I think what that means is Canadian wine is going to get more expensive come June 30th, 2022.
So are you saying, Heather, to stock up?
So most years we're telling you to fuel your vehicle before a certain date, and this year I'm telling you to buy Canadian wine, I guess.
Yeah. All right. So I don't know how I ended up with tax administration, but here we go. So there has been, I guess, a few changes with Canada Revenue Agency and our taxing center there. And we'll just cover a few of these really quickly, or well, I might cover a few of them not quite so quickly, but so this, there is a rule called the General Anti-Avoidance Rule that says, even though you might have followed the tax legislation, you found a loophole or something that you thought you followed the rules, but really it wasn't the intention of the legislation. The government has had this General Anti-Avoidance Rule that they can use to reassess taxpayers. And they have found that they don't think it's quite working the way it is fully intended. So they are going to have a look at this. And again, we'll probably see some proposals introduced possibly by the end of 2022. So as Heather said, the fall economic update may have some interest in it, but I hope that's as much as anyone on the call will ever know about GAR. The funding for Canada Revenue Agency. So in every budget the last 2 years, they have expanded and increased the budget going to Canada Revenue Agency. And this budget 2022 is providing another 1.2 billion over the next 5 years. And they say that they're really going to focus on auditing larger entities, non-residents engaged in aggressive tax planning, trying to increase investigation and prosecution of those involved in criminal tax evasion, and also to expand its educational outreach. So hopefully they will spend more on the last one, and the other two, they do need to spend more money on, but hopefully they'll be more successful with it. But this one is where I did pull a graph here just for interest's sake to show in 2018 and 19 what the Canada Revenue Agency's budget was compared to what they are now receiving today. So if you feel that you're getting more letters from Canada Revenue Agency, or they're asking you for more information, they likely will. And again, back to my comment about, please, if you're deducting things, make sure you're keeping good books and records. Make sure you're keeping those receipts for the required time frame. You know, they say you're supposed to keep everything for 7 years, so make sure you're keeping that. We have found in our office that we are getting, our clients are getting a lot more letters just asking for, certain line items on their tax return to provide information about them and to provide documentation for it. And I will say, for the most part, CRA, they reassess from these letters mainly because taxpayers don't respond to them. So if you do get a letter from CRA, make sure you are responding or take it to your accountant. I do know a lot of taxpayers, these letters seem to get lost as well. So please, if you do get a reassessment, make sure you act on it right away. And the other part where they do succeed is just the lack of documentation that taxpayers keep in order to send into Revenue Canada. So if you're expensing it, keep the documentation. You don't have to keep the receipts. If you want to scan them, keep them digitally, but just make sure you're keeping your books and records. And that's what I'll go on about on that side. Their Audit Authority has changed a little bit as well. This has been some proposed legislation that hasn't quite made it all the way through yet either. But CRA can require, if they want to have oral examinations written or electronic formats, they can kind of question you in different ways. Again, I would say if you're looking at being audited by CRA, make sure you have your accountant with you. We usually, for our clients, want to be there if they're asking questions. They always seem kind and nice, and they ask what seems to be quite nice questions, but they're usually trying to find something out. So just remember to watch out. Another administration change that is coming in to watch for is that they are now going to require any payments and remittances greater than $10,000 to be made electronically through financial institutions. So if you're having to pay a large corporate tax bill or make a large payroll remittances, some people like to go down to the bank and make them by a check. Watch, they are changing this to be more electronic. They have allowed, though, which has been quite nice, but we still haven't seen the legislation pass on it, is to allow taxpayers to e-sign certain forms. So you've probably been sent forms to sign so that you can just electronically sign them. It does help with the signing process and speed things up. So we're hoping that that will continue. And again, CRA has been trying to change over where they're sending out less papers. They do want to do things more on the electronic side and send communications. And this one, I will say, please beware. CRA, the only emails you should be getting from them or anything to respond is one saying we've posted something to your account, and there should never be a link to your account there. So never follow a link in an email that you think might be from CRA. Always, leave that one and log on to your CRA website through normal means. Don't go through any links, and look and see what's there. If you're getting any phone calls or anything that says we need to be paid right away, please talk to your accountant or talk to someone else. Chances are it is a scam, and whoever does these scams, they've been very successful and they keep doing them. So please, again, just be wary of that.
I would say nowadays, the only people that ever phone me are people that say that they're going to arrest me for not paying my taxes. So.
Well, I have to say we have a landline still at home, and I don't know who phoned it this morning, but my husband said that we might not have one when I get home today because he's tired of it. So my keeping of the landline might be over now because yes. Some other tax measures, and this one I will say I don't know anything about at all, but if you are dealing with the registered charity world, they have proposed in the budget 2020 to increase the disbursement quotas. So a lot of charities have the disbursement quotas that they have to follow, and that rate is going to change from 3.5% to 5%. And then there is some administrative outliers there if it's over $1 million. So just watch that if you're in the charity world and that is something you deal with, that is proposed to change. And I know why I got that one, because I left international to Heather.
Well, this is going to be a fast and furious update on the international tax measures. So I guess the highlight here with respect to any of these, I guess, tiles on this page is that CRA is proposing in conjunction, I guess, with the OECD or the Economic Development Committee to engage in international tax reform and ensure that all corporations are paying their fair share and level the playing field of taxes between Canadians and Canadian businesses with other tax regimes. So this includes an update to the beloved FAPI, or foreign accrual or foreign property income inclusion rules. I'm sorry, interest coupon stripping, which is shopping for, I guess, an interest rate on your debt. Digital services tax, so your Netflix tax or your streaming tax, and a global minimum tax, just to boil Tracy's blood, similar to the AMT or alternative minimum tax. So it is intended to be a multi-pillar approach. A couple of different pillars announced in yesterday's budget. The first one being bitten off would be the digital services tax. We've seen this with the GST in prior years' budgets to make sure that GST applies to, the Netflix tax and the Disney Plus and the Amazons and all of those things. But this is the first one that we're going to see is the digital services tax, and making sure that these large digital corps are paying their fair share in the jurisdiction in which the content is being used or consumed. So if the international tax measures are your cup of tea or of interest or impactful to you, there's some more reading to do there, but this is intended to be a high-level overview because neither Tracy or I are experts in this area. And back to you.
Great job, Heather. So we're just going to cover a few things, and I said February 4th, but this kind of goes back to even last budget on a few things that are still out there, and we're still kind of waiting for the final details to show up. So last year with the budget, they had announced that there would be an immediate expensing rules to allow for, and they started off with corporations, mainly CCPCs, to expense 100% of certain property purchased by the company, up to $1.5 million for an associated group. So this included quite a few different things, machinery, equipment, but it did exclude buildings and a few other classes. So at this point, though, the legislation has not passed for the allowing of the deductions to happen. And they did also, though, expand, because last year they just were allowing corporations to have this deduction, and now they're allowing individuals and partnerships within individuals as members to also receive the same deduction. And again, they would have to be buying property after January 1st, 2022, and the property must be available for use if you're a company prior to 2024. If you're an individual or a partnership with only individuals as members, 2025. And I'll go on a limb and say, I hope the legislation passes before 2024, but we're still waiting. And I will say, you know, with some of this, please be kind to your accountant because we're waiting for this. And at this point, we're filing tax returns where we can't make this claim. And we will have to, once the legislation goes back, based on what our clients want, we may be going back and amending lots of tax returns. So we are hoping that this passes sooner rather than later, just to not have to keep amending a lot of tax returns. The next one that came out last year that we're still waiting on, that I'm sure everyone is waiting on too, is the luxury tax proposals. So this again came about in the part of the 2021 federal budget, and it proposed to tax certain luxury cars, aircrafts, and boats. They did release some draft legislation for consultation on March 11th, and it's expected that these rules will come into effect for September 1st, 2022. So if you're buying a vehicle worth more than 100,000, a personal use aircraft worth more than 100,000, or a boat with 250, I still don't know how they came up with the different numbers, but if you're planning on making these purchases, do so before September 1st, 2022, or you'll be paying a tax of the lesser of 10% of the total purchase price or 20% of the total purchase price exceeding this threshold. And just to add a kicker to that, GST will also be charged on the luxury tax. So you get tax on your tax. Of course, with everything, there is exemptions that apply. So they are trying to get after more personal use items here. So if it is something that is very much business use, make sure you are checking though to make sure that you do qualify for the exemptions. And if you are someone that is selling these items, there is going to be some registration required for certain businesses, and the business selling these items will be required to collect and remit the luxury tax, and potentially as well some returns to file. So again, we don't know exactly what this will all entail at this point in time, but if this is something that does impact either your purchasing or your business of selling, please make sure you're paying attention to this one. So I think we're almost done here. So kind of, you know, what do you do now? And my crystal ball rolled off my desk years and years ago, so I would like to have it back at some days. But you know, right now, you know, most of what we say to our clients is, you know, what is your objectives? And we want to make sure that your structure you're in right now is meeting your business objectives, meeting your personal objectives, and making sure, again, when it comes to planning, succession, estate planning, you know, it's never too soon to start, and it's never too late to do it either. So please make sure you're kind of doing the planning that you want to do, and that you know, ask questions and make sure your goals are being met. And I think, you know, it is everyone's situation is different, so everyone's plan should be a little bit different as well. So I'll turn it back to Heather for some final thoughts.
Awesome, thank you. Yeah, so I guess just in closing, you know, I would really like to find that crystal ball somewhere in your office, Tracy. I think that, you know, Budget 22, you know, provided some good measures, and there was a number of personal, corporate, and indirect measures, and lots of focus on housing. But there was a lot of uncertainty still left, I think, in our planning and what's going on. You know, there's so much speculation out there every time a budget day comes along, or every time an economic update comes along with respect to what's going to happen with tax rates. And you see all of the articles in the Financial Post and the Globe and Mail on speculation of, you know, increasing tax rates to cover off deficits and capital gains rates changes. And I guess my rant here is addresses point number 2 with, you know, new things were introduced here, and we still have varying levels of detail and certainty, and in particular with Bill C-208. But as we continue to see things unfold, we will make sure that we're keeping everybody apprised of it, and check back to our website and subscribe for updates as we go along here through the year. We hopefully will get some more certainty and more detail on various measures as well. So with that, great big thank you to the Chamber of Commerce team. We appreciate you hosting us today, and for the very gracious introductions. I think you oversold us, but oversold me. But we really appreciate you guys hosting us and letting us use your platform, and we appreciate all of you members joining us today, and learning about something that's obviously very near and dear to mine and Tracy's heart, and what's impactful to you and your businesses.
Thank you so much. At least I think I've got my money's worth. If the accountants to go and buy copious amounts of wine and they might buy a luxurious car, how can you go wrong? So thank you for some of that advice. I just want to see, Tom, can you maybe see if we have questions? We still have time for questions. Anything in the chat box, perhaps?
Nothing in the chat box at the moment. There was a comment about heat pumps and the efficiency in cold weather, but other than that, we haven't seen any questions yet.
No raised hands here.
Must have been well explained.
I sure think I've listened to some of it yesterday, and I must say, Tracy and Heather, you definitely describe it a lot easier, and really great information, a lot that you covered in this amount of time, and really appreciative of the clarity. I would advise, like you said there in the end, go to MNP's website and definitely sign up for updates as well. And alluded to there in the closing comments, there's still a lot of detail that's missing. I might just have a quick question just on this whole foreign investment, and it's probably not really a taxation question, but what I gathered from it is that non-Canadians can't buy, and I mean it's a proposal still, but that they can't buy residential properties for potentially 2 years. Any ideas why they pick 2 years? Maybe just a comment on that.
Yeah, I would say, I think it's, again, targeting probably the Vancouvers and the Torontos, where they do compete for housing. So, people in Canada that need a house to live in, it makes it kind of unfair when they're competing against foreigners that are just buying a property to either as an investment purely, or to live in for a short period of time during the year. And I don't know, anytime they propose things like this, there's always seems to be a workaround that shows up. So hopefully they can do it in a way that will be impactful and will allow these people to be able to buy an affordable house.
No other questions at this point. Well, I'll just have a few. Tom, we don't see any others. So thanks again, Tracy and Heather, and your insights really valuable, and especially Tracy on those tips with CRA. One thing I'll definitely just add there, the tech in me is with CRA, definitely they make the option available for two-factor authentication. So make sure you sign up for that as well, just to give an extra layer of security. A few reminders of upcoming events. We continue this Community Pulse series. On April 13th, we're featuring the Northwestern Polytechnic. State of the Region is set for April the 22nd, and that's a hybrid event with in-person and virtual options. We have a Communicate for Profits webinar on April 26th. And exciting about our non-profit charitable sector business showcase, which is on April the 28th. And our big event, the Peace Region Energy Show, May 18th and 19th. That's only to name a few, and visit our website, grandprairiechamber.com. And thanks again, everybody. Great participation here today. And I wish you a great rest of your afternoon. And as Tracy and Heather said, keep those receipts and have a wonderful weekend.
Thank you,
Thank you,
everybody.
everyone.
Take care.
Thank you.
Bye-bye.
Yeah.